Picture this, you finally found a community that feels right. A cozy little condo complex with just 12 units. Small enough that you know your neighbors. Small enough that things should be simple. And with an HOA board made up of people you live next to every single day, you'd think the community's business would be handled responsibly. Now, imagine sitting at your desk one evening, scrolling through your email, when something catches your eye, the insurance renewal packet for your building's master policy. This is the policy that protects the entire property. The roof, the walls, the structure, the things every homeowner relies on when disaster strikes. Most people don't even look at these documents, but you decide to take a peek. At first, it looks routine. Pages of fine print, coverage amounts, deductibles. But then you notice something odd. Very odd. On page 3, in bold type, the application lists the roof replacement year as 2022. Wait, what? That can't be right. You remember clear as day the last roof project was in 2015. You even remember the scaffolding, the noise, the mess. 7 years earlier. Your eyebrows furrow, but you keep reading, and then you hit the part that makes your stomach drop. The section labeled Rentals. Are there any short-term rentals in your community? Answer, no. Are there any long-term rentals? Answer, no, but that's a lie, a blatant, undeniable lie. Because out of 12 units in your building, at least 4 are rented out to tenants. That's 33% of the property, 1/3, including 1 unit owned by the very person who submitted this application. And that person just so happens to be your HOA president. You fire off an email pointing out the discrepancies. Maybe the roof year could be an innocent mistake, but how does a man who owns a rental unit claim, in writing, that there are no rentals? The reply comes back fast, short, dismissive. Oops, too late now, had to turn that in by Friday. That's it. That's the answer, and suddenly your mind races with questions. What happens if there's a fire? What happens if a storm rips through the neighborhood and damages the roof? Will the insurance company discover the false information and deny coverage? They comb through every document, every answer, every line on an application, looking for reasons to deny a claim. And if they discover that your HOA submitted false information about rentals, about roof age, about anything, they have the perfect excuse to walk away. That means you and every other homeowner in the building could be on the hook for tens or even hundreds of thousands of dollars. And the worst part, now that you can't unknow it, if you stay silent and a claim is denied later, other owners might blame you for not speaking up. You could even be sued personally because as a board member, you have a fiduciary duty to act in the best interests of the association. So now you're trapped in an impossible position. If you say nothing, you risk financial disaster. If you blow the whistle, you risk being labeled the bad guy, the troublemaker, the neighbor who called out the president and stirred up chaos. This is more than just a clerical error. This is a ticking time bomb. And your HOA president lit the fuse? Let's slow down and set the stage. This story takes place in a small 12-unit condo building. We're not talking about some massive HOA with hundreds of homes and endless bureaucracy. This is small-town scale. You would think that in a community this size, things would be more transparent, easier to manage, more neighborly. Like most condos, this one carries a master insurance policy. Unlike your personal homeowner's policy, the master policy covers the shared structure, the roof, the siding, the foundation, and often the common areas. Without it, one major disaster could bankrupt the entire building. That's why getting it renewed properly each year is one of the board's most critical responsibilities. This year, someone found a new broker offering a better deal. Great news, right? A chance to save the association some money, lower premiums, maybe even ease the financial pressure on residents. At first, everyone's happy. But then comes the application. The broker submits forms filled with details about the property. Things like, when was the roof last replaced? Are there rentals in the community? What kind of construction materials were used? How many units are owner-occupied? These aren't just casual questions. They're the backbone of how insurers calculate risk. A newer roof means fewer leaks and fewer claims. Fewer rentals supposedly means a more stable community. Answer wrong, and your premiums go up. Answer right, and they go down. But answer dishonestly, that's a whole different ballgame. In this case, the roof was listed as replaced in 2022, but that S faucet was 2015, and the no rentals answer? That's not just misleading, that's flat out untrue. Because 4 units, 1/3 of the building, are rented out long-term, including one owned by the president himself. So how did this happen? Was it an innocent oversight? Did the broker misunderstand? Did the president misremember? Or was this a deliberate attempt to make the community look less risky, shaving dollars off the premium at the expense of honesty? When confronted, the president didn't offer clarification or even concern. Instead, he brushed it off. Oops, too late now. As though signing off on false information was no big deal. But it is a big deal. Because if disaster strikes, if a claim has to be filed, the insurer can and will use that false information as grounds for denial. And that could mean financial ruin for the entire community. It's one of those moments where you realize just how fragile HOA governance can be. One person with a pen and a signature can gamble with the financial security of every homeowner. And the scary part, most residents will never know. They'll trust that the board handled everything correctly until it's too late. This sets up the core conflict. Does the homeowner who spotted the errors stay silent or act? Because either choice comes with consequences. And in HOA politics, being the bad guy can sometimes feel worse than being right. The homeowner thought the storm was over. But in reality, it was only just beginning. When the garage shutter came crashing down on their brand new car, the damage wasn't just to the vehicle's paint and panels. It was to their trust in the condo board, in the property management, and in the entire system that was supposed to keep residents safe. The first response from the HOA, silence. Weeks went by. Emails disappeared into the void. Calls were not returned. And in those empty days, the anxiety grew. Overlay Reddit screenshot highlighted, quote, I reported the incident to the condo board the same day, but nobody responded. My car was sitting there with a massive dent, and I didn't even know if insurance would cover it. Think about that. A mechanical failure in a shared structure, something every resident pays into through monthly dues, caused real financial harm. And yet the people responsible for maintaining that structure acted as if it never happened. Here's where things took a sharp, almost surreal turn. When the homeowner finally pushed harder, showing up in person, demanding answers at a board meeting, the HOAS position was blunt. Overlay direct quote. We're not responsible. The garage shutters are considered limited common elements. That means repairs and accidents fall on the homeowner. Now pause for a second. Limited common elements is one of those HOA legal phrases that sounds technical, but in plain English it often means it's shared by everyone, but somehow you're on your own. That's the trap. And this homeowner was staring right at it. Scene suggestion, B-roll, close-up of legal documents with words like limited common elements and liability being highlighted. Cut to a shot of a cracked garage door slamming down. The homeowner pushed back. How could a resident possibly maintain or service something like a garage shutter? It wasn't like replacing a light bulb in their own unit. These were heavy-duty mechanical doors, controlled and installed by the condo itself. If it failed, shouldn't he the association? The people collecting thousands of dollars every year for maintenance? Step up? The HOA didn't budge. In fact, according to comments on the Reddit thread, the board doubled down. One commenter captured the frustration perfectly. Overlay Reddit comment. This is exactly why HOAs are hated. They'll collect money every month, but the second something actually breaks, suddenly it's not their problem. This wasn't just about the car anymore. It was about principle. The homeowner began documenting everything, the damage photos, the failed shutter mechanism, even the maintenance logs or lack thereof. And guess what they found? No record of recent inspections, no receipts for preventive maintenance, nothing to show that the shutters were even on the HO's radar. That discovery only fueled the outrage. Narration shift, dramatic. Imagine paying $400. $600, maybe even $1,000 a month in dues. And then, when the very infrastructure your money is supposed to protect collapses, you're told, sorry, not our problem. The homeowner didn't stop there. They called their insurance company, and here's where things got messy. The insurer, predictably, wanted to know who owned the liability. Was it the condo's common property or the homeowners? Without HOA cooperation, the claim dragged on. What could have been a straightforward repair turned into a bureaucratic nightmare. At this point, the Reddit post began attracting attention. Other residents and even outsiders with HOA experience chimed in. Some advised immediately hiring a lawyer. Others warned that the HOA might suddenly produce a clause buried in the bylaws, absolving themselves of responsibility. A few even suggested the homeowner take the board to small claims court for damages. Overlay Reddit comment, document everything, they'll try to weasel out of it. Small claims is your best bet. Scene suggestion, B-roll, stack of photos and documents being organized, gavel slamming in small claims court. The escalation reached a boiling point when the homeowner received what can only be described as a tone-deaf email from the board. Instead of offering to help, the board suggested that the homeowner contact a contractor directly and pursue repairs through private means. That was the breaking point. From the outside, it looked like negligence. From the inside, it felt like betrayal. Here was a structure every resident relied on, and when it failed, the HOA's strategy was simple: deny, deflect, and distance. But here's the thing about stories like this. They don't stay quiet. Reddit amplified it. Viewers like you hear it. And suddenly, what might have been one person versus a board of 5 becomes a spotlight on an entire system. Because let's be honest, this isn't the first time an HOA has dodged accountability. And it won't be the last. And that's exactly where this story shifts from one broken garage shutter to a bigger nationwide problem. Because what happened here isn't rare, it's part of a pattern. And the numbers prove it. What happened in Seattle may sound outrageous. A garage shutter falls, damages a resident's car, and the condo board refuses to take responsibility. But here's the truth. This is not an isolated incident. It's a symptom of a much bigger, systemic issue in America's HOA and condo world. Across the United States, there are more than 365,000 homeowners associations and condominium boards, governing an estimated 75 million residents. That's nearly 1 in every 5 Americans living under HOA or condo control. And while the sales pitch is always the same: shared responsibility, maintained property values, community harmony, the reality often looks much darker. Scene suggestion, B-roll, montage of pristine HOA marketing brochures, followed by quick cuts of real-life HOA horror stories, cracked sidewalks, flooded basements, broken elevators, angry residents in board meetings. A broken promise of maintenance. The first promise of any HOA or condo is maintenance. You pay dues, sometimes hundreds or even thousands a month, and in return the shared structures and facilities are kept safe and functional. But in practice, boards frequently underfund reserves. That means there's not enough money set aside for repairs. A national survey by the community associations Institute found that 70% of associations are underfunded when it comes to long-term maintenance. Think about that, 7 out of 10. So when the time comes for a major repair, a roof, a garage door, a pool, or worse, a life safety system, the association's first instinct isn't to pay for it. It's to deflect, to stall, or to pass the cost directly onto the homeowners through special assessments. In Seattle, it was a garage shutter. In Miami, it was far more tragic. The shadow of Surfside. The most devastating example of failed maintenance came in 2021, when the Champlain Towers South Condominium in Surfside, Florida, collapsed in the middle of the night, killing 98 people. The investigation revealed years of deferred maintenance, ignored engineering reports, and an HOA board that simply couldn't or wouldn't act on the warnings. Surfside was the worst-case scenario. But it forced the country to confront a truth. When condo boards neglect infrastructure, the consequences aren't just financial, they're fatal. Scene suggestion, B-roll, archival footage of Surfside collapse, respectful slow-motion stills, Overlay of news headlines reading ignored warnings and board knew of structural issues. Everyday abuse, the legal hammer for most homeowners. The nightmare doesn't involve collapse. It involves conflict. And in those conflicts, HOAs often wield one of the most powerful weapons available, the lawyer's letter. Take the case of a California homeowner who installed a small interior doorway in her own house. The HOA fined her $500 a day until a new state law capped the fine at $100. Or the Georgia condo owners at Waldrop Place, who had their water shut off by the HOAS contractor, even though the board had no legal authority to do so. Or the thousands of homeowners across Texas who faced foreclosure over something as small as unpaid dues or disputes over fences, paint colors, or yard maintenance. Overlay Reddit comment: the HOA is like having a landlord without the landlord's responsibilities. They can fine you, threaten you, but when something breaks, they vanish. Accountability gaps. So why does this keep happening? One reason: accountability is murky at best. Most HOAs are run by volunteers. These are neighbors, sometimes well-intentioned, sometimes power-hungry, who suddenly find themselves managing millions of dollars in collective property. Very few have formal training in law, engineering, or finance. On top of that, management companies and boards can hide behind layers of bylaws, covenants, and state laws that vary widely across the country. In some states, like Florida and California, HOAs are heavily regulated. In others, oversight is almost non-existent. That patchwork means homeowners often don't know where to turn when things go wrong. Local government? They'll often say it's a private community matter. State regulators, in many cases, they don't exist. And so the HOA's word becomes final unless you have the time, money, and energy to fight back in court. Scene suggestion: beer roll, courtroom footage, homeowners protesting outside condos, lawmakers debating HOA reform bills. The financial trap for many: the problem isn't just negligence, it's money. Monthly dues are supposed to cover shared expenses. But when boards mismanage funds or delay repairs, residents are hit with sudden special assessments, sometimes in the tens of thousands of dollars. In one Arizona condo development, owners were billed $20,000 each for emergency repairs to roofing and siding. Many simply couldn't pay. Some were forced to sell. That cycle, high dues, surprise assessments, and no clear accountability is what makes HOA and condo life feel less like community living and more like a financial trap. HOA horror stories go public. What's changed in recent years is that these stories no longer stay within the neighborhood. Platforms like Reddit, TikTok, YouTube, and Facebook groups have become megaphones for HOA abuse. Search HOA Nightmare on YouTube and you'll find hundreds of videos with millions of views. Reddit's HOA board is filled with daily posts, photos of bogus violation notices, stories of intimidation, accounts of financial secrecy. The Seattle garage shutter story is just one of them. But together they form a mosaic of frustration that's impossible to ignore. The bigger picture. And here's where the contradiction lies. HOAs were created to protect property values. That was the mission. To make sure lawns looked neat, roofs didn't leak, and shared spaces were preserved. But in case after case, boards either mismanage, overreach, or abandon their duties altogether. They want the control of landlords without the responsibility. They want the money of government without the oversight. They want the appearance of community while fueling conflict behind the scenes. And homeowners, the very people paying into the system, are often left powerless. The Seattle case is just one thread in this larger fabric. And when you zoom out, the pattern is undeniable: neglect, denial, and abuse of power. But what does the law actually say? Can an HOA really wash its hands of responsibility when a shared structure collapses on your property? In the world of HOAs, facts matter, but so does law. When an HOA president submits misleading information or worse, knowingly lies on an insurance application, the fallout isn't just financial. It's a serious legal and ethical breakdown with potential consequences for every board member and homeowner involved. Reserve funding, a national weak spot. Many HOAs are treading water when it comes to maintenance. According to financial watchdogs, 70% of associations are underfunded, with reserve accounts averaging only 52% of recommended levels, a drop from 60% a decade ago. CNBC imagined that nearly three-quarters of associations lack enough reserves to replace a failing roof or keypad system. Now pair that with misrepresented roofing dates or rental occupancy suddenly, your HOA isn't just negligent, it's reckless. State laws heading toward reform, some states are waking up to the risks. Take Maryland's HB 107 enacted in October 2022 in direct response to the Surfside tragedy. Now, all community associations statewide must complete a reserve study, update it every 5 years, and fund the recommended reserves within 3 fiscal years, regardless of whether bylaws restrict assessment increases. Wikipedia the fallout? Ocean City condo owners face 5 to 6-figure special bills. One community saw a $250,000 special assessment split among residents to rebuild depleted reserves. Wikipedia. Ethical spotlights don't get brighter if meaningful reserves are required. Transparency and accuracy in insurance paperwork aren't optional, they're essential. Reserve study requirements across the U.S. Reserve studies aren't just Maryland's focus, they're becoming standard. States like California, Florida, Hawaii, Nevada, Virginia, and Washington legally require them. In fact, for FHA or Fannie Mae lending, lenders demand current reserve study documentation. Wikipedia, if your HOA ignores this or worse, falsifies information, not only could claims be denied, lenders and secondary buyers may send your property value plummeting. HOA Board Fiduciary Duty. State by state, the law treats HOA board members as fiduciaries entrusted with homeowners' interests and finances. Even as volunteers, board members must meet high standards, duty of care, make informed decisions, research before acting, and consult professionals when needed. Nolo Gordon James Realty Duty of Loyalty. Avoid conflicts of interest. Acting in personal interest? That's a breach. Nolo Gordon James Realty Duty to act within authority. Stay within the bounds of CC and RS, bylaws, and state law. Nolo Gordon James Realty in California, for example, the Davis-Sterling Act enforces these duties. Directors must act in good faith and with prudent judgment. Failure such as neglecting reserve funding can result in personal liability. Vero Law Group Echo Wikipedia. Similarly, in Georgia, breach of fiduciary duty arises if a board fails to act in good faith or without reasonable inquiry, causing harm to the HOA, Freeman Mathis and Gary in North Carolina. While they don't have blanket statutes on this, homeowners are protected by fiduciary duty principles under state nonprofit corporation law. Homeowners may pursue mediation or legal action if the HOA fails its duty. Justia Aska Layer Carolina Common Elements False insurance applications equals dangerous territory. Falsifying information on insurance forms isn't a technicality, it's a tangible risk. In many states, California, even an unintentional misrepresentation can justify policy denial or rescission. Reuters. Florida. Misrepresentation, omission, or incorrect statements allow insurers to deny claims. Reuters, Kentucky. Similar occupancies misstatements on insurance apps can void coverage. Reuters, moreover, courts have held that misrepresentation about pets or boarders can void entirely unrelated claims like dog ownership, leading to a fire claim being denied. Reuters. In short, your HOA can't gamble with dishonesty. If discovered, your entire policy and the building's financial safety net could evaporate. Ethical implications. Trust is fragile. Truth matters more in a system built on trust. A board that cuts corners sends a message. Money and optics greater than integrity and safety. That's not community. That's coercion. When the HOA president knowingly or negligently misrepresents data, it amounts to betrayal. Not just of best practices, but of neighborly trust. In this story, the owner who flagged the error isn't the villain, the only rational person in the room. Because someone has to act responsibly before the expensive, tragic, or both real-world consequences arrive. Legal dimension key takeaway. Reserve funding. Most HOAs are underfunded. Some states now require mandatory reserve studies. Fiduciary duty board members must act with care, loyalty, and within authority violations can lead to personal liability. Insurance misrepresentation, false info can void coverage, even if not intended to deceive. Ethical responsibility, truth is foundational. Failing at it endangers lives, property, and community harmony. With those laws and statistics in mind, you can see that this isn't just neighborhood drama, it's a legal and ethical crisis. Up next, we'll bring in real-world experts, lawyers, insurance specialists, HOA professionals to unpack exactly how this kind of crisis plays out and what homeowners should do to defend themselves. So far, we've seen how this HOA president wasn't just a neighbor managing paperwork. He became the single point of failure for an entire real estate deal. But how does this happen? To answer that, let us step into the minds of the people who deal with these power struggles every day: attorneys, HOA consultants, and real estate experts. First, let's hear from the legal side. When an HOA president also serves as treasurer and controls financial documents, they essentially hold the keys to the castle. Most states require HOAs to provide financial disclosures within a set time frame when a property is being sold. For example, in California, Civil Code Section 4525 requires associations to provide a package of disclosures, budgets, financial statements, governing documents within 10 days of a written request. If an HOA drags its feet, they can actually be sued for damages caused by the delay. In other words, when this president ignored the lender and realtor's requests, he wasn't just being difficult, he was potentially stepping into legal liability. Buyers' financing often depends on these documents. Without them, banks won't move forward. No documents, no loan, no sale. And that means the homeowner's investment is trapped by one person's silence. But what about intent? Was this a matter of neglect or something darker? Sometimes it's not about laziness. I've seen board members weaponize delay. They know that by holding on to documents or refusing to respond, they can pressure the homeowner into concessions, or worse, sabotage a sale they don't like. It could be personal, it could be financial. But make no mistake, withholding required records isn't just poor management. It's a form of control? That's chilling when you think about it. A volunteer with a title can stall thousands of dollars in transactions simply by not sending an email. And unlike government officials, HOA boards don't always face direct oversight. Unless someone sues, their actions often go unchecked. Now, from the real estate perspective, this kind of obstruction doesn't just hurt the seller. Buyers walk away all the time when HOAs delay. Time kills deals. If disclosures don't come through quickly, lenders get nervous, buyers lose interest, and properties sit on the market. And that hurts the whole community. It drags down property values and erodes trust in the HOA. This is where the ethical side comes into play. The HOA isn't just serving one resident, it represents the collective interest of the neighborhood. If a single officer blocks a transaction, they're not just hurting one homeowner, they're undermining everyone's investment. Now let's zoom out for a moment. Experts point out that this problem isn't rare. In many states, disclosure laws exist on paper, but enforcement is weak. HOAs can face fines or lawsuits for failing to provide records, but most homeowners don't have the time, money, or energy to take legal action while also trying to close a sale. The imbalance of power is massive. Legally, the homeowner has the right to those documents, but practically, they're racing against deadlines. Lenders don't wait forever. So even if the homeowner eventually wins in court, the damage is already done, the buyer is gone. The law is reactive, not preventative, and that's the harsh reality. The laws exist, but HOAs often bank on the fact that people can't enforce them in time. It's a game of attrition, one that homeowners rarely win without suffering losses. So what can homeowners actually do? If you face obstruction, document everything. Save emails, texts, and letters. Send certified requests so you have proof of delivery. In some states, like Florida and Texas, HOAs have strict timelines to comply. If they miss the deadline, you can escalate through state agencies or even demand attorney's fees if it goes to court. But the golden rule is create a paper trail. HOAs can deny conversations, they can't deny a signed receipt. That advice matches what countless homeowners have echoed online: receipts, receipts. Because without evidence, it becomes your word against the HOAS, and we already know how that usually plays out. Finally, let's talk ethics. Experts say HOA boards need to remember why they exist in the first place: to serve the community, not control it. Transparency is the foundation of trust. When a president or treasurer goes rogue, it doesn't just create drama, it erodes the social fabric of the neighborhood. The irony is, HOAs were created to protect property values. But when they withhold records or obstruct sales, they're doing the exact opposite. They're creating instability. They're making buyers think twice about moving in. Long term, that hurts everyone, even the board members themselves. So whether this was negligence or malice, the expert consensus is clear. The HOA president's refusal to cooperate wasn't just frustrating, it was dangerous. Legally risky, ethically indefensible, and practically disastrous. It's a perfect storm of power imbalance, weak enforcement, and personal ego, the exact recipe that fuels so many HOA nightmares. We followed this case from start to finish: a homeowner ready to sell, a buyer eager to close, a lender needing only the standard financial disclosures. And yet, one man, wearing two hats as HOA president and treasurer, brought the entire process to a halt. At its core, this isn't just a story about documents or delays. It's about power. One volunteer, elected to represent a community, became the gatekeeper of someone else's financial future. By refusing to respond, he placed personal will above collective duty. And as we've seen, this isn't a one-off fluke. It's a reflection of systemic weaknesses in how HOAs operate across the country. The laws exist. States like California, Florida, and Texas have clear timelines for disclosure. Penalties are written into the books, but enforcement? That often falls on the shoulders of individual homeowners already under financial and emotional stress. And in real estate, time is everything. A delayed document isn't just an inconvenience. It can erase months of planning, cost thousands of dollars, and poison trust in the entire community. So what's the takeaway? Experts agree on 3 points. Document everything, because in HOA disputes, evidence is your shield. Know your state's laws, timelines, disclosure rights, and penalties vary, but the rules are usually on the homeowner side. Push for transparency. HOAs were created to protect value, not destroy it. Communities function best when leaders see themselves as stewards, not gatekeepers. For homeowners, this story is a warning. For board members, it's a lesson. And for communities everywhere, it's a reminder that trust is fragile. Once broken, it's hard to repair. In the end, the obstruction of a home sale isn't just a legal technicality. It's a human cost. Families delayed in moving forward. Buyers walking away, neighbors left wondering if they'll be next. And all because one person refused to do their duty. Justice, in cases like these, doesn't always come from a courtroom. Sometimes it comes from awareness, from shining a light on the patterns, the loopholes, and the behaviors that erode communities from within. And that's why stories like this matter. Because the more we understand how power is abused, the better equipped we are to protect ourselves and to demand better from the associations meant to serve us.